Good evening, friends. Hope all of you are doing well. We have already completed two sessions. First session, we have discussed about basics of financial management. Second session, we have discussed about procurement and application of funds and how the balance sheet is prepared and the relevance of balance sheet in the financial management. Now, in this session, I am going to discuss about objectives of financial management, role of finance manager, and we will discuss some practical issues relating to what we have already discussed relating to cost of capital, EVA, and all those things. And from next session, we'll go to tools of financial management. Now, my friends, I wish all the students of chartered accountancy, cost accountancy, all the best for the coming examination in the month of July and August. You got some more time and you are at home, you are safe, and I wish you are preparing well, and the examination will definitely bring fruitful result for all of you. These video sessions will be very much useful to you and it will be helpful for all the students. Subscription is free, so it will be useful for all the students at every corner of the country. Now, let me tell about objectives of financial management. I will not discuss in detail, I will not make it more lengthy, I will just go to the point, okay, and I will tell you what basically is the objective of the financial management. Some people say that if you are having a business concern, then your basic objective should be to maximize the profit. Because whenever you carry on the business, obviously you need to make profit so that you will progress. But whether profit maximization is the real objective so far as financial management is concerned, as a finance manager, though every business has a set of objective to increase its profitability, but profit maximization should not be its sole objective. Its sole objective, in fact, should be to maximize the wealth of the business. Now you will ask me, so what is the difference between maximization of profit? Because if profit is maximized, then obviously the wealth of the business will be maximized. Then what is the difference between profit maximization and wealth maximization? Normally, when I say my objective is to maximize the profit, I compromise with certain things. Say, I sometimes compromise with business ethics. I sometimes compromise with statutory compliances. I sometimes compromise with the policies relating to the business for the welfare of the laborers, for welfare of all the stakeholders of the business. I'm not talking about the shareholders. The difference between shareholder and stakeholder is that shareholder are the owner of the business. They put their money in the business in the name of capital and they need return from the business. But stakeholders are all those persons who have interest in the business. They may be shareholders, they may be debenture holders, they may be finance providers, they may be the government exchequer who has interest by means of taxation, okay, general public, okay, who are the consumers to your business. So all these are stakeholders. Our ultimate objective is to justify the interest of the stakeholders rather than justifying the interest of the shareholders only. For example, if I am manufacturing a product and if I am a profit seeker, I may compromise with the quality of the product with the intention of making more profit. But if my objective is to justify the interest of the stakeholders, then obviously my ultimate objective is to improvise the quality of the product so that the customers will be more interested about my product, and in future there will be a demand for my product and my future will be prosper. My future will prosper. Okay. So when I say my objective is to maximize the interest of the stakeholders rather than the shareholders, or to justify the interest of the stakeholders rather than the shareholders, then obviously I am futuristic in nature, okay, and I am trying to get a boost to my business with an objective of one, sustainable growth, two, to bring more interest in my business through the stakeholders. Now, if you are a public and a listed company, then obviously your shares are listed in a stock exchange, and if people are interested in your company's share, then demand for the share of the company will rise, then obviously the market price of the share will increase. So when I say wealth maximization, it necessarily means taking necessary steps to improve the market price of the share, or to improve or to increase the market capitalization of the company. If you ask me about a particular industrialist, whether he is number one wealthy entrepreneur of India or not, then normally we look into what is his market capitalization, how many shares he hold in different companies, what is the market price of the shares, and if we multiply market price of share with the number of shares held, then the sum of that will represent the total market value or the total wealth of the promoter or the main shareholder of the company. So wealth is measured by means of what? Market capitalization, and not by means of profitability of your company. So I will suggest, whenever you think about objective of financial management, your sole intention should be to maximize the wealth of the company rather than the profit of the company. One of the measures through which you can identify the wealth of the company is the capitalization of the earning per share of the company. What is earning per share? Earning per share means profit available to the equity shareholders divided by number of equity shareholders of the number of equity shares of the company. This represents the earning per share of the company. If I capitalize it with the cost of equity, that means the opportunity cost of the equity shareholders, then obviously I will get the market value of the equity of the company. It is see, different valuers adopt different methods for valuation of shares of the company. I will have a separate video, several videos relating to valuation management, where we will discuss about valuation of financial assets and securities separately, but that will be later on. It is the advanced financial management. But for the time being, let me clarify that one of the approach or one of the way whereby we can simply identify the market value of the shares of the company or wealth of the business of the company is capitalization of the earning price per share of the company. So identify the earning price per share, identify the opportunity cost of the shareholders, we'll go into cost of equity, and we'll try to find out different methods through which we can find out the cost of equity of the company. Then we'll capitalize the earning price per share with the capitalization rate to find out the market value of the share of the company. If we multiply the market value of the share of the company with the number of shares traded, then we'll get the wealth of the business of the company. At any moment of time, when we are making a trend analysis of the business, we should see that the overall wealth of the business is showing an increasing trend over a period of time. For example, let me tell, suppose my sales is 100 crores, my cost of goods sold is 60 crores, then my gross profit is 40 crores, then my all other expenses including interest and taxes, all these are say 30 crores, then my profit available to the equity shareholders is say 10 crores, okay, and number of shares traded is 1 crore, then my EPS is 10 crores divided by 1 crore is equal to rupees 1. And if my capitalization rate is 10%, okay, then 10 divided by 0.10 is equal to 100 is the value of my share. Okay, 10 crores is my profit available to the equity shareholders, number of equity shares 1, so EPS is 10 crores divided by 1 is equal to 10. If I divide it with the cost of equity, say 10%, then 100 is the value per share. When I multiply it with the number of the shares, that means 1 crore into 100, then 100 crores is the wealth of my business. That means the market capitalization of my business. Every year I will try to give an increasing trend to this market capitalization. This is the wealth of the business. I should not look into just to increase the profit of the business on year to year basis. My ultimate objective is to improvise the market capitalization, which represents the wealth of the business. So, one thing keep in your mind, the objective of the business should be wealth maximization rather than profit maximization. Now, what is the role of a finance manager? Or I can go to a top level. What is the role of a CFO? Who is the CFO? CFO means the Chief Finance Officer of a company. The role of CFO is to look into the overall financial affairs of the business, to, to look into the optimum utilization of the financial resources of the company. 3. To look into the different measures that the company should take to actively participate in the financial policy decision making so that there will be wealth maximization on year to year basis. So if you ask what the CFO do, what is the role of a top level finance officer, then I will tell you he is not involved in day to day financial operation. Point 2, he looks into strategic financial policies of the company. Point 3, he is actively involved in strategic financial decisions for the future sustainable growth of the business. Point 4, he actively look into all future projects on the hands of the business. He take his team into confidence and try to find out whether a particular project what the company wants to undertake will bring fruitful result and will bring value addition to the business. It is not just profit, it should bring value addition to the business. Okay, so role of CFO, if someone asks you what is the role of the top level finance officers of a company, he is involved in strategic financial decisions of the company, he is involved in capital investment decisions, he is involved in foreign financial policies, all these things. And if someone asks you what is the role of finance manager of a company, then the role of finance manager who is maybe in the primary managerial position, his role is what? To look into working capital management, that funding for working capital, optimum utilization of the working capital, to look into the working capital cycle, how to minimize it and how to maximize the profit of the business, to look into the different non-trade investment opportunities available to the business, to park the surplus fund of the business, to look into the day-to-day planning for the receivables, day-to-day planning for inventory management, to look into what different sources from which capital can be procured at an effective cost. Okay, so that return of the business will be improvised, or to bring value addition to the business, or to improvise the economic value addition of the business. Okay, all these things, capital investment opportunities, small capital investment opportunities, scrutinizing those and advising the top level management regarding different opportunities available to the business. Okay, all these things, treasury management, cash management, all these things, okay, is the role of the finance manager. Okay, so with this I complete the basics of the financial management. We discussed about what is meant by finance, what is meant by financial management, how financial management deals with procurement and application of funds, how at every moment of time we have to manage the assets and liabilities of the business, how balance sheet plays a major role in ultimate financial management of the company. We discussed about objectives of the financial management. Okay, we discussed about how the profit of the business can be optimized. Our ultimate objective is to optimize the profit, optimize the return rather than maximizing the return. Okay, so you just keep in your mind there is a difference between maximization of profit and optimization of profit. When I say maximization of profit, I am compromising with several things, but when I am saying optimization of return, then I necessarily mean I am in the process of minimizing the risk and maximizing the return. Whenever I will go to capital investment decisions, I will separately tell you risk management practices for a company. Very, very interesting topic. We will discuss about that in our subsequent videos. Okay. Now, let me give you some practicalities, okay, relating business development through financial practices. Let us take an example. Let our capital structure is like this. Since it is an initial video, so I'm not going into the advanced parts like tax planning and all those things. Subsequently, we'll discuss about corporate tax planning and financial management. But for the timing, I'm ignoring tax and I'm discussing about, okay, how the profit of the business can be optimized. Suppose my equity is say 40 lakhs and my debt is 60 lakhs. So my total capital is 100 lakhs. Suppose cost of equity is say 15% and cost of debt is 12%. I'm ignoring the tax impact. Subsequently, we'll discuss about the tax factor. Okay. So you will ask me, Sai, why cost of equity is more than cost of debt? Equity shareholders take more risk, therefore they expect more return. They need some premium over the risk-free rate of return. Debt providers get fixed rate of return, therefore they take lesser risk, therefore their expectation is also less. So the 3% spread is the premium the equity shareholders are getting over the debt providers due to the additional risk taken by them. Okay. Now, what is the weighted average cost of capital in this case? Step 1, find out the weight of the equity and weight of the debt. My total capital is 100 lakhs, equity is 40 lakhs and debt is 60 lakhs. So weight of equity is 40% and weight of debt is 60%. Okay. Now, cost of equity 12%, cost of equity 15%, cost of debt 12%. Now, my weighted cost of equity is 15 multiplied by 0.40, which is equal to 6%. My weighted cost of debt is equal to 12 multiplied by 60% is equal to 7.20%. So what is my weighted average cost of capital? Weighted average cost of capital is equal to weighted cost of equity plus weighted cost of debt, which is equal to 6% plus 7.2% is equal to 13.2%. Now, my dear friends, you remember my total capital employed in the business is 100 lakhs. My weighted average cost of capital is 13 lakh 20,000. So I need a minimum profit before interest. Since I am ignoring tax, I need a minimum profit before interest of 100 lakhs multiplied by 13.20% is equal to 13 lakh 20,000. This is the minimum profit I need from my business. Now let us go to the operational part. Suppose my sales is equal to 80 lakhs. Situation 1 I am telling. My sales is equal to 80 lakhs. My cost of goods sold is equal to 56 lakhs. So my gross profit is 80 lakhs minus 56 lakhs is equal to 24 lakhs. Now, suppose my indirect cost is equal to 10 lakhs. Then what is my profit before interest? It is 24 lakhs minus 10 lakhs, which is equal to 14 lakhs. It is my profit before interest, 14 lakhs. Now, my dear friends, I told you my minimum profit required is equal to 100 lakhs multiplied by 13.20%. My cost of capital is equal to 13 lakh 20,000. Here I am getting profit before interest of 14 lakh. So my economic value added is 80,000. Since EVA is positive, the business is viable. The business is viable. Every business should have a positive EVA. Here I am ignoring tax. Whenever I will go to the chapter cost of capital, I will show you the calculations through tables and all those things. Okay. But for the timing, I am just giving a background of all these things. If your business have a positive positive EVA, then obviously, okay, the business is profitable. Scenario 2, sales same 80 lakhs. You can write it on papers, okay, for your understanding. Cost of goods sold same 56 lakhs. Gross profit 24 lakhs. Suppose my indirect cost is 12 lakhs. Then my profit before interest is 12 lakhs. But what is the minimum profit before interest I desire? It is 13 lakh 20,000. So my EVA is negative 1,20,000. Now my friends, in both cases I am making profit. Suppose in second scenario I deduct the interest element. What is my interest? 60 lakhs multiplied by 12%. It is 7,20,000. In second scenario, I deduct the interest. 12 lakh minus 7,20,000. I get profit to the equity shareholders of 4,80,000. I am getting a profit to the equity shareholders. But can you tell it is advisable to run the business? Or if it is a public company, to go for a disinvestment? Equity shareholders will ask you, sir, if we invest in the debt of the company, we'll get 12%. By investing in the equity, we are getting same 12%. 4,80,000 divided by 40 lakhs into 100, same 12%. So why not to shift to debt without taking any risk? By investing in equity, we are taking risk and we are getting 12%, but without taking risk, they are getting the same 12%. So they will sell the shares of the company. There will be an increase in supply of the shares of the company. The market price of the share will fall down and the market capitalization of the company will fall. At any moment of time, the chief objective of the chief financial officer should be to look into different alternatives through which market capitalization will be improved, wealth of the company will be increased. But if this practice goes on for a long period, for 1 year, 2 year, 3 year, 4 years of time, you are not meeting the expectation of the shareholders. Shareholders are not getting a return of 15% what they are expecting. Then obviously a point of time will arise where they will start selling the shares of the company. And once the shareholders start selling the shares of the company, the market price of the share will come down and the wealth of the company will go down. Even if you are the promoter of the company, even if you are the Mukesh Ambani of the company, okay, who will be interested in looking into the company's falling market price? Every promoter, every shareholder of the company invest in the company with a solo objective that the market price of the company will increase in the future. My main interest is in increase in market price of the share, not in getting annual dividend. You know, dividend is given on the face value of the share, and face value of the share is very small. Okay, so ultimate aim, ultimate objective is what? Ultimate objective is to increase the market capitalization of the company. So at any moment of time, every company should look into one fact, that how the economic value added of the company will be widened instead of narrowing. वो narrow नहीं होना चाहिए, वो widened होगा. This should be the objective. So I will tell, EVA is a very important concept. Whenever I will go to the taxation part and cost of capital, I will discuss in detail regarding how the EVA is calculated in a taxation environment. We'll discuss that. Since it is a basic class, I do not want to make it complex. Okay. So I am in the process of developing a studio where we can have a whiteboard and we can make a better presentation and we can look into the practicalities in a most interesting way. We'll solve big problems for the benefit of basically financial analysts, for the benefit of high level financial executives, for the benefit of chartered accountancy students, cost accountancy students. And yes, chartered accountants and cost accountancy students who are giving their examination this July, I suggest them to attend these classes. This is just 30 minute session every day. I will post maybe alternative days or every day. Just sit and hear this 30 minute session. This will be more useful during the examination, I assure you. Okay, I assure you it will be more useful. Okay, next session we'll go into the practicalities. I will start with tools of financial management. What are the tools of the financial management? Just like the engineers, the technicians have their tools to making repair and maintenance of plant and machineries. Similarly, the finance manager should be always ready with his tools to take the financial decisions. These tools I will discuss one by one with ultimate detail. Okay, may not be ultimate detail, may not be possible in certain scenarios, but still I will try to clarify your concepts. I will try to clarify your concepts. The tools of financial management, I will start with one, time value of management, my next session. Second, I will go to financial performance analysis, that is ratio analysis. What are the financial ratios and how they are useful in measuring the financial performance of the business. Then I will go to risk management tools. Okay, how to measure the risk of a business, what are the different tools used to measure the risk of the business. Okay, these three tools I will discuss one by one, and thereafter I will directly go to project management first. In project management, we'll discuss how to prepare project report, how to make financial projections, what are the different tools for making the financial projections, and risk and capital budgeting techniques in detail. Though I may not be in a position to solve numerous problems, but I will try to cover each and every concept related to project management. So stay with me for financial management. I assure you the best of industry standard finance education through this. My solo objective is not to make money through these videos. My solo objective is to make education free, because today our government has given so many boost to MSME sectors, and finance is going to play a major role. Financial professionals are going to play major roles in boosting or in making India the world's biggest self-reliant country. As Prime Minister Narendra Modi rightly said, self-reliant country necessarily means to depend on ourselves and to make the world happy simultaneously. That means we will improve and we will bring a smiling face to the world. We'll bring a smiling face for the world. Okay, so let's be a partner in nation building. Let's be partner in making India the biggest self-reliant country of the world. Thank you. Meet you in the next video. Stay safe, stay home, and again I am telling, COVID-19 कहीं जाने वाला नहीं. It will be with us. So from today onwards, from this time onwards, we should make it a practice to have mask, to have a sanitizer with us always, to maintain social distance, to keep ourselves safe, and to actively participate in making India the biggest self-reliant country of the world. Thank you.